What if you could learn, borrow, and earn interest from your money without necessarily going through the traditional banking system? How is that possible? You earn money, you earn interest on your money without necessarily going through our banking systems. How is that possible? That is the idea behind DeFi. DeFi, also known as the decentralized finance, is a financial system that is built on the blockchain network, and it is powered by smart contracts. In today's lesson, we are going to be breaking down DeFi for us to understand. We're going to understand everything about the decentralized finance, commonly known as the DeFi. We are going to talk about stakings. We are going to talk about yielding, farming. We're going to understand how you can actually earn interest on your cryptocurrencies without necessarily going through the banks. Hello everyone, you are welcome once more to today's lesson. In our previous lesson, we have been talking about cryptocurrency. We spoke about cryptocurrency entirely. We spoke about the types of different cryptocurrencies. We spoke about crypto wallets. We spoke about crypto exchanges. If this is your first time you are coming across my video, please, you can refer back to my page. You can go back to my channel and you will get more insight about my previous videos. In today's lesson, we are going to be breaking down DeFi, also known as the decentralized finance, to the understanding of everyone. What is DeFi? What is decentralized finance? Decentralized finance, also known as DeFi, is financial services that are built on the blockchain network. There are financial services that are built on the blockchain network that allows people to be able to access services such as lending, borrowing, trading, and earning interest on their money or their cryptocurrencies without necessarily relying on intermediaries such as our traditional banking systems. Yeah, you can earn, you can borrow, and you can lend without needing a third party to mediate this transaction. So how is this possible? Of course, we know in our traditional banking system, if you want to lend money or if you want to borrow money, the bank acts as the intermediary. They mediate this transaction. You sign the agreement, and the money now is loaned to you. You must meet certain conditions, and the bank is solely in charge and in control of this entire transaction. But DeFi is actually trying to reduce or replace these intermediaries, this middleman transaction. DeFi is actually trying to eliminate the activity of the intermediaries by actually including what we call the smart contracts. We discuss about smart contracts and how smart contracts work, that if certain conditions are met between both parties, those conditions must be met before a contract is executed, signed, and stored on the blockchain network permanently. So DeFi are actually trying to replace the actions of the intermediaries such as our traditional banks. Instead of you depending on the banks to loan you money or to lend money or to borrow this money, you look for someone on the blockchain that actually wants to lend this money or to borrow this money for interest. And you guys will sign an agreement that is based on the blockchain level. This is something that is actually fascinating because it's something that nobody could actually picture it coming into reality, but we are actually seeing smart contracts executing this transaction 100% accurately. How DeFi work? So, how do DeFi actually work? Decentralized finance, how does it work? There are apps, these DeFi apps, we call them dApps. These apps actually allows individuals to do this transaction based on what we call the smart contracts mediation. So when certain conditions are met, these conditions are programmed. These smart contracts like we define are programmed, an agreement that is programmed to mediate or to initiate a transaction between two parties. Someone, let's say the lender, comes onto the blockchain and put his funds. His funds are there. Someone that is the borrower comes when the person meets those conditions. The smart contract is signed. The person borrows the funds and in turn pay interest. That interest now is redistributed between the lender and the blockchain as per the programmed. So this is fully automated by the smart contracts. The good thing is it is permissionless. Anyone can actually, if you have the requirement, you can actually participate on the DeFi. It does not need a central control. It is decentralized and it works based on smart contract execution. If I'm talking about smart contracts and you are not actually understanding what I mean by smart contracts, I thought about smart contracts on this channel. You can refer back to my channel, to my lesson I was teaching about smart contracts, and you understand exactly how smart contracts work. We said smart contracts are automated or programmed agreements that are being signed between two parties without actually a third party coming into play. Two strangers come together, they execute transactions. These transactions are mediated, they are signed, and they are authentic. They are recorded on the blockchain network. So what DeFi does is this application we call the dApps. They give access to people to come on these applications. They can borrow, they can lend their money to earn interest with the mediation of the smart contracts. Smart contract is solely responsible for the mediation of transactions on the dApps. You put your money, somebody wants to borrow that money, the person has to meet those program rules that has been set on that smart contract. Take for instance, this person has to attain this certain level of this. You have to own this. You have to be verified. You have to own an account. You have to be a KYC user before you can actually lend or borrow money from these dApps. Those are conditions that are met by the smart contract. And two users coming together to execute a transaction. That transaction cannot be validated. A smart contract cannot actually be signed if these conditions are not met by both parties. Lending or the lending protocols. So, like we said, people can lend. What people do is DeFi allows users to come and deposit their crypto holdings. For instance, USDT, the stable coin. You deposit these holdings into a lending protocol and add liquidity or a liquidity pool. Now you are the lender. You put your money on these lending pools that are being run by smart contracts. Borrowers can come and borrow that money you put in that lending pool. People that actually need to use that money, that want to use that money, can come. They borrow your money from there with the execution of smart contracts. Like I said, they must meet those programmed rules set by the smart contracts. So when they come, when they meet those rules, this money is being lent to them. They can take this money, they can use the money, in turn pay interest. So the main idea of lender is to earn interest or also to participate on an internet or a network rather. So what they do is they put their money into the lending pool. This money is borrowed by borrowers. They can use this money. Then in turn they pay interest. When they pay interest, this interest is now shared between the network and the lender. The lender earns interest. This is a way to earn money rather than keeping your money in the traditional bank, or if you have stable coin, instead of keeping them in your wallet sitting there, you can actually join lending pools to add liquidity, or you add to liquidity pools. What you do is you can actually sign this contract and put this your money into a lending pool so that people can borrow this money they use. When they borrow your cryptocurrencies they use, they intend pay back. When they are paying back, they pay plus the interest they borrowed to pay with, as based on the smart contracts agreement. So smart contracts are solely in control of this agreement. You don't need to bother because you need to sign your contract. You need to sign your own part of the contract as a lender, that you actually own this fund and you are putting this fund on the lending pool for someone to be able to borrow and use. Then the person borrowing also has to sign his own part as the borrower, as per programmed on the smart contract rules. So you also sign your own part of the smart contract, and this money is loaned to you. You use this money, and within a specific period of time you are given, you come back, you pay back this money. You sign the contract again that you have paid the money into the lender's account, and with the interest it is being shared. So the lender earns interest while doing nothing, rather than just putting their money into a lending pool for people to borrow, use, and pay back with interest. This is also a way of earning why you don't trade. Borrowing. So let's talk about borrowing on the DeFi. How is it actually taking place? So DeFi allows people to come and borrow other assets. You can go on the lending protocols. You borrow other assets, but then you don't just go and you borrow on the DeFi protocol, on the lending protocols. What you do is you have to prove collateral. You have to show a collateral before you can actually borrow from the lending protocols or lending pools. What you do is, for instance, I need you to use USDT. I am having Ethereum. What I do is I actually put this Ethereum on a DeFi. I sign a contract that I have this Ethereum, but I want to borrow maybe 500 worth of dollars worth of USDT. So I have a collateral. My collateral is the Ethereum. This is to avoid the risk of theft on the blockchain. You must have a collateral to show that you own something before you can be given this fund. It's not like you just go on the lending pool and you are borrowing. Not everyone can just go into the lending pool and borrow. You have to show proof of collateral. And most often, most people that borrow, they don't want to sell. For instance, I have my Ethereum. I don't want to sell that Ethereum, but I needed USDT. I just put my Ethereum on the lending pool. I borrow from there. I still own my Ethereum. When I come back, I pay back the USDT I borrowed plus interest, and I'm still in possession of my one Ethereum. So most often people don't actually want to sell the cryptocurrency they are holding, but they need another cryptocurrency to use. They use the cryptocurrency they are having as a collateral. When they use it as a collateral, they sign the contract. They are lended. They are loaned these currencies these cryptocurrencies, they get these cryptocurrencies, they use. When they come back, they pay with interest. The interest now is then paid to the lender, the person that actually has the cryptocurrency you borrowed from that lending protocol or lending pool. So this also adds to liquidity on the blockchain. Liquidity pools. So what is a liquidity pool? A liquidity pool simply is a collection of crypto assets locked on a smart contract program or a blockchain. These cryptocurrencies, we say the lenders, they come, they deposit their cryptocurrencies. When the borrowers want to borrow, they also show proof of collateral. All these cryptocurrencies are locked on in these smart contracts. They are locked on this blockchain and are controlled by these smart contracts. So the more people deposit money there, the more they add to the liquidity pool. And liquidity pools are very important because they maintain the running of that network. For instance, if a high transaction takes place and there's not enough liquidity, it might affect the running of the entire network. It might crash the entire network. So people actually deposit their money. For example, let's say Ethereum and the USDT liquidity pool. People with those funds, they actually deposit both Ethereum and USDT inside the liquidity pool. Now, people want to come and borrow. They come there, they borrow. When they are paying back, they pay all those transactions, the gas fee, everything. The people that actually deposited this money into this liquidity pool earn from those gas fee, transaction fees. They earn from it. So a liquidity pool is simply a collection of this cryptocurrency assets. Yeah, you collect all these assets, and these assets are governed or they are controlled by these smart contracts, the programmed agreement that run these transactions and make transactions possible on the blockchain network. So liquidity pools are very important because they actually helps in the functioning of a network system effectively. Yield farming. So what is yield farming on DeFi? Yield farming is simply a process of moving or depositing asset into a protocol, a yielding protocol. People deposit their crypto asset into these protocols, and in the end, they earn interest. They earn from gas fee, they earn from transaction fees, and they also benefit from activities of the protocol entirely. So why is it called yield farming? It is called yield farming because they actually put in their cryptocurrencies and yields. The more people use borrow from those pools, those protocols, the more people borrow from there and use, the more they pay gas fee, the more they pay transaction fees, and the more the people also benefit from all of these activities. So it is called yield farming because actually it yields interest. These people are paid, they gain interest. Take for instance, you can participate in a USDT Ethereum yield pool. You go there, you deposit Ethereum, and you can also deposit USDT. People come there, they swap from maybe one currency to another. The more they use your currency that you deposited, the more you also gain from the gas fee, the transaction fees. And you can benefit, there are certain benefits that you can also benefit from the entire protocol itself. So yield farming is simply people coming together and depositing their cryptocurrencies into a protocol or like a lending protocol. You come in, you put your own cryptocurrencies there. They are being controlled by these smart contracts, we say. As a smart contracts are being executed, gas fee are being paid, transaction fees are being paid. You that you deposited your money into these pools, you also benefit from part of those transaction fees and those gas fees. You also benefit from them. That's a means of putting your cryptocurrencies to work. Most crypto traders will say they put their cryptocurrencies to work by actually depositing into this yield farming. They look for a pool. They deposit their asset into that pool. And as people are borrowing, as people are exchanging, as people are doing transaction in that, using that pool, they generate interest from their assets. Staking. So how is staking also working on the DeFi? Like we discussed earlier about staking. We said a staking mostly work based on a blockchain network that practice what we call the proof of stake. Individuals come here, they lock up their cryptocurrencies. They actually own these cryptocurrencies. They lock up these cryptocurrencies to maintain the functioning of this network. When they lock up these cryptocurrencies for a period of time, they don't use those cryptocurrencies for that period of time they have locked the cryptocurrency for. These cryptocurrencies are used. And now, these people that actually lock these cryptocurrencies here, they have the chance to be selected to be the next validator to add the next block on the blockchain network. So they act like validators. They actually act like validators, but they lock up part of their cryptocurrencies to be eligible, to be chosen to be the next validator. As transactions are going on, you can be chosen to be the next validator to verify that transaction. And of course, you know how validators validate the verified transactions. They make sure the person sending has sufficient funds. There's a sender address, there's a receiver address, there's a gas fee has been paid, this timestamp has been put, the transaction hash has been generated. All of those stuffs, the validator has to check it. So these validators, they must put up part of their cryptocurrency, lock it on the blockchain network to be eligible to be chosen as a validator. But this is how staking come. In turn, they receive interest, they are paid, they are rewarded. Whenever we validate a transaction, you are rewarded the transaction fee from that transaction. You are rewarded with the transaction fee. The gas fee, you are also rewarded as part of the transaction as a validator. So people stake their cryptocurrency to be validators and also earn from the transaction fees and the transaction entirely. Importance of DeFi or the decentralized finance. We have discussed about the DeFi entirely. You have seen how important DeFi has also come in to solve a lot of problems we have been facing. DeFi have actually brought a lot of financial services on the blockchain. It has brought up lending, borrowing, loaning, trading, liquidity pools, yield farming, staking. All of this has been brought on the blockchain network by DeFi. And many people are actually embracing this new system because anyone can actually participate on it. You don't need to be verified. You need to own an account and you can actually participate on uh, this technology, on the DeFi. You can actually be a part of the DeFi. You can actually borrow, you can actually learn, you can actually earn from your cryptocurrencies by putting them or locking them up or putting them into a liquidity pool for people to come, borrow, use. Then they pay back with interest. So DeFi has actually brought a lot of financial services, put them together in a single platform that anyone can use, access it conveniently without actually needing an intermediary. That is the most important aspect of it. It is still very decentralized. Means once you meet these conditions, you can participate on the DeFi without needing a central authority or an intermediary. So I hope you enjoy yourself from today's lesson. It was explicit enough for everyone to understand. If you have doubt, you can always ask at my comment section for clarification because I'm always reading your comment. And if you're enjoying yourself, please, you do well to like, subscribe, invite others, let them join the journey because it is getting interesting every day. In our next lesson, we are going to be talking about NFTs. NFTs, also known as non-fungible tokens. We are going to understand what NFTs are, how NFT come about. So it is an interesting lesson that you wouldn't want to miss. And I will see you in the next one. And until then, you stay blessed.